And so right now, I would say we're basically going into a economic deceleration in an otherwise stagflationary environment. And so I think this is a rather defensive. You generally want to be more defensive at this time and focus on things that have real world utility.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. 2022 has been a headache year so far for investors. Most financial assets remain down double digits percentage-wise versus the start of the year. There are growing signs that the red-hot housing market is fast cooling too. And it's hard to make the case that prices will pick back up again soon, given that the Federal Reserve remains fully focused on destroying demand in order to bring today's hot inflation under control. So will the pain in the markets get even worse from here? Are we hurtling towards a stagflationary recession? Well, for an informed perspective, we're fortunate to be joined by macro analyst Lyn Alden, who's just returned from speaking at an international conference in Norway and is speaking to us despite having just come down with COVID. Lyn, thank you so much for joining us today.
Thanks for having me. Happy to be here.
All right, Lyn. Well, look, thanks so much for doing this. I'll try to get through this as quickly as possible, but I did make the error of asking my audience in advance what questions they would like me to ask you, and I ended up getting thousands. So we're just going to crunch our way through it as best we can. But before I get to the questions, the specific questions, let me kick this off with a general question I always ask you when you come on, which is, what is your current assessment of today's global economy and financial markets?
So I think the underlying problem is that we've underinvested in a number of real world systems, right? So commodities, especially energy, as well as we've highly diversified our supply chains globally. Basically, we've optimized for efficiency over resilience, and we're kind of getting the call on that setup, right? So we're kind of quickly finding out the world's not quite as peaceful as we thought it was. And that if we underinvest in some of these natural resources, we're going to be short them when the time comes. And so we have these real world constraints, and combined with the fact that we increased our currency supply by quite a bit, we've run into inflationary problems. And the Federal Reserve and other central banks can't print more of those real goods and services, but they can try to curtail demand. And so right now they're doing the best attempt to jawbone demand lower, while trying also to avoid an outright recession. And historically, the Fed's ability to do soft landings is not very high. It's a very kind of low, maybe a couple times they almost did it, but for the most part, it's like an on or off switch. And so right now, I would say we're basically going into a economic deceleration in an otherwise stagflationary environment. And so I think this is a rather defensive. You generally want to be more defensive at this time and focus on things that have real world utility.
All right. Actually, excellently succinct summary. So we sort of have more currency units, chasing fewer things, and I'm saying fewer things because we are having some big supply chain shortages still lingering, and so to deal with that, because the central banks can't print up more real things, they're trying to drain the pool a little bit to get the inflation under control. You said we're going into an economic deceleration into a stagflationary environment. I think I got that correct. And I'm just curious, we'll get into this in the specific questions in a second, but stagflation is when inflation remains hot, but economic growth gets stagnant. If you think we're heading into a period of stagflation, how long do you think it will be? In other words, how long does it take for stagflation just to become recession? Because finally demand destruction begins to bring the inflationary prices down, but you're stuck with the stagnant economic growth.
Partly that will depend on policymaker decisions. But for example, if you go look at the 70s, even during the economic slowdowns, the recessions in the 70s, you still generally had pretty high inflation. You just had, maybe you took the edge off inflation compared to some of the most inflationary periods. And so my general view is that this whole decade is probably going to be somewhat stagflationary. Basically, we're going to have supply side problems, particularly on the energy side, I think, for quite a while, for years at least. And whether or not we, bring inflation down to, let's say, official CPI down to 6%, 5%, 3%, depending on how low we go, that partially depends on how forceful central bankers are willing to be and how to what extent politicians are able to deal with recessionary conditions. Because right now, the clear, if you ask people out there, what is the biggest problem, they'll say inflation. And right now we're starting to see kind of a slight uptick in initial jobless claims. And so I think, to the extent that they try to continue tightening by pulling back on stimulus and tightening monetary policy, I think we're going to see a shift towards a weaker job market. And you kind of can turn an inflationary problem into an unemployment problem. But you can also have both at the same time. And so I think that there are scenarios where they could cause like some sort of deflationary bust temporarily. Like you could kind of, cause a severe contraction. But I think that unless they push it that far, I think we're in more of this kind of malaise where, energy prices are high, they're kind of the constraint. And they can be in a big choppy range if you're really trying to hold demand down, but it's like holding a volleyball underwater, right? It's, holding a beach ball underwater. And so I think that, I think I would use the analogy that we're kind of rounding a corner going very quickly, where we see the long run where we're going, which I think is much higher energy prices, much higher inflation. But right now you have to kind of put the brakes on and slow down and be careful with your investing around this corner, because this is the period where central banks are trying to fight back. And so for the next several months, as long as we're going to experience quantitative tightening, raising rates, and no new stimulus from Congress and things like that, I think it pays to be defensive around the margin and to look towards maybe some degree of disinflation. Not necessarily that inflation will go away, but that we might not keep going up at the same pace that we were, at least that, especially outside of energy. And so that's how I play this. Basically, I think that we can almost have a barbell approach where you stick with energy types of investments, but then you also look at some of the more defensive types of things like cash and even treasury bonds.
All right, great. I'm writing this down so that we can revisit it later on. I've said a couple of times a month or two ago that the really big question for 2022 really is how big of a backbone does Jerome Powell have, right? Which is essentially what you're saying, where it's really going to come down to central policy at this point in time, which is how much pain are they going to be able to stomach in terms of raising rates here and the impact of bringing demand down. You've referenced the 70s. I want to get to that a little bit more in just a minute, but I agree. It sounds like we could maybe have something similar there, where we had several Fed chairs before Volcker came in with the mandate to break inflation. I think a lot of people kind of forget that there were several predecessors of his that were trying to fight inflation, but they just couldn't stomach bringing the rate up as high as it ultimately took to bring it under control. So do you see something similar here, where we're kind of, Powell and maybe whoever comes after him are going to be, trying to talk tough, but maybe not really have the cojones to do what it's really going to need to be done to tame inflation? So we're going to have persisting inflation and this economic malaise and kind of be in the sort of chop range that you were just talking about?
I think so. And in some ways, it's worse than that, because in the 70s, you had very low debt levels. And so at the end of the day, Volcker could raise rates to very high real levels. And it caused a recession, but it didn't cause like a financial crisis, a depression, because you had pretty low debts in the system. So the economy could withstand those higher rates with a slowdown. And before Volcker passed, he even said he couldn't do that today. And it's only gotten worse since then. And so that's one reason I've used the 40s as in many ways a closer comparison than the 70s, because in the 40s you had very high debt levels due to the war and due to things like that. And so despite the fact that they had high inflation, they just had to hold rates low anyway. And so you had a big decoupling between rates and inflation. And we've already seen that play out so far. And so even though they're talking tough, they're still, rates are still below 1%. And so they're moving up pretty slowly, despite the fact that we have multi-decade high inflation. And I think that's a testament to how much debt is in the system. And so I think we're kind of in an environment where inflation is going to be a persistent issue. They're going to try to talk tough, but at the end of the day, the math, matters, right? So, for example, if they cause the credit market to become illiquid, if they cause the treasury market to become illiquid, if they, cause an outright recession, we start to see high employment, that makes it very challenging for them to continue doing what they're doing. And so I think they're kind of stuck between a rock and a hard place, and that the release valve ends up being this weird situation where they're unable to keep tightening despite the fact that inflation is much above their target.
All right. God, so many great things to unpack there. I'm going to put up a chart here that you retweeted of Charlie Biello's recently, which speaks to this massive disconnect between inflation and central bank courage to tighten. Just reading Charlie's tweet here, he says, Eurozone inflation has moved up to 8.1%, its highest level ever. Meanwhile, the ECB is still holding interest rates at negative levels. This is perhaps the greatest disconnect between easy monetary policy and unabating rising prices that the world has ever seen. Now, this chart doesn't look totally different from the situation in the US. We're a little bit better, but not that much better. So to your point, there's so much debt out there. Is this really a testament to the trap that the central banks are in here, that they're just not going to be able to act as tough as they are talking, because they will ignite the powder keg of debt that lays out here if they try to raise rates too much longer?
Yes, I think that's a good way to describe it. And that's, that was summed up by Ray Dalio's long-term debt cycle thesis. And that's something that I've incorporated in my research starting several years ago. And one thing I've found is that looking back in history has been able to make some sense of the situation. So it goes back to the old quote, history doesn't repeat, but it does rhyme. And so the history can't tell us what's going to happen. It's not like, okay, here's step 1, 2, 3, and here's step 1, 2, 3. But a lot of people keep describing this as unprecedented or saying we've never seen something like this, where actually we have. It's the 40s. The last time we had a disconnect this big between rates and inflation in North America and Europe was the 1940s. And so because of Ray Dalio's good research and the research of others, and then adding my own research on top of it to kind of look at that thesis, for the past few years, I've been expecting this higher inflation, but not the correspondingly high interest rates, which is what we've seen. It's kind of a specific outlook, and now we're starting to get that kind of that slow rate rise, but it's starting from such a low base, and we're kind of already testing the limits of how high that I think they're going to be able to get. And so I think that pretty much sums it up. That they've encouraged so much credit growth for decades that they have a massively high level of debt to GDP, and that's true in the United States and in Europe and Japan and elsewhere, super high debt levels. And then therefore, when we finally have a true inflationary impulse, basically lack of commodities, supply chain problems, and a lot of money creation, they're unable to raise rates to try to tame in that inflation, or at least to the degree that they need to.
All right, I'm going to ask a couple rapid fire questions here. One is, you said the Fed and the other central banks, they don't have a great track record of soft landings, right? So what do you think the odds of them getting away with this are, right? In other words, is there really a chance that they can kind of somehow thread the needle and come out of this gracefully? Or is the best case scenario here that we are just living with persistent higher inflation than we've been living with for the past couple decades?
I think there are very few ways for them to have a soft landing here. I think Luke Roman described it best, that basically outside of some sort of massive unexpected productivity increase
Right.
that happening, it's really hard to see a way out, right? Because basically, in order to have real growth, meaning inflation adjusted growth, we'd have to bring more energy online.
Right. And I'm sorry to
And
interrupt, but in your answer, I want you to address this. So you've mentioned the 40s a couple of times, but coming out of the war period in the 40s, one, we had the enviable position of being the best economy, ready to help meet all the rebuilding demand growth and stuff like that. But we also had cheap hydrocarbons coming online there that gave us a multi-decade tailwind. We don't have that now.
yeah, so in the 40s, a lot of that spending could be turned off, right? It wasn't kind of based on aging demographics and things like that, right? So we could do some degree of austerity after the war, as well as rebuilding. And as you pointed out, we had abundant natural resources. We were not really kind of tapped into heavily the whole kind of world reserve. At this current time, we don't really have new supply coming online anytime soon, or at least any sort of significant new supply. And so, if you're asking me this question in the 2030s, maybe eventually there we have a, kind of a we've kind of gotten through some degree of pain and we're building up from there, right? So maybe by that point, that'd be part of discussion. But I think as we sit here in the 2020s, it's more like the early 1940s, right? There's still a lot of stuff ahead. Now, hopefully not the same type of stuff as the 1940s, but in terms of fiscal and monetary policy and, different entities fighting over resources, essentially. Hopefully not very kinetic, but we're already seeing some kinetic actions, but hopefully, not a lot of kinetic. But I think that we're still early in that process, where it's kind of premature to talk about soft landings. Now, in the cyclical sense, right now they're trying to decelerate the economy, and the question is, can they kind of take the edge off and then stop tightening for a little while and then go back to kind of normal stagflation, perhaps if they're forward looking. But I think that the idea that we're going to get to stable prices and positive real yields anytime soon, and then maintain those for quite a while, I think that's the part that's far-fetched, right? So we can always have these moments of, disinflationary issues, and you briefly have positive real yields in terms of, say, actual inflation compared to, say, treasury yields. But I think that the ability to normalize anytime soon is pretty much off the radar.
All right. So then this is where it gets interesting then. So, thinking back to that chart that I just showed of Charlie Bielow's, let's say the Fed does a couple more rate hikes and then it pauses or pivots, but let's even just assume they pause, right? Sort of two questions here. I imagine if they do, I know that at least Bill Fleckenstein thinks that that's the moment where the Fed is going to truly lose the bond market, where the bond market's going to say, you know what, guys, there's no way you can get inflation under control, and you've just proven it, right? And therefore, the bond market's going to really start taking, longer duration yields up even higher. So is there a chance that this could get away from the Fed? That they're trying to engineer the soft landing, but they either slow the market, the economy too far, too fast in the process, or it's just so anemic that it can't handle even the slightly higher debt levels. And then, of course, if the bond vigilantes begin taking yields even higher, could that start a cascade that really takes this process away from the Fed?
So I think so, but then it comes down to a Fed decision, right? So, for example, that's kind of the end game for this particular long-term debt cycle, is the Fed having to capitulate on tightening despite the fact that inflation is still high. And that's been my thesis for a while, that they're going to get to that point. The question is, what do they do then? The Fed can always choose to override the bond market with formal yield curve control, right? And this is something I've been eventually anticipating. We've seen it in Japan first, where the Bank of Japan just comes out and says, I know you want to price bond yields higher, but we're not going to let you. We're just going to do an unlimited bid with printed money to peg yields at what we want to do. So the Federal Reserve can come out and say, I know you want to raise yields, but we're just not going to let that happen. We're not going to let the 10-year go above 3%, for example. And the offset would be massive currency devaluation, right? So there's
Right,
no
that's where
free
I was going to
lunch.
go. Exactly.
Yeah,
Yeah.
there's no free lunch. And so if they control yields, they get massive currency devaluation, which is basically massive inflation. And if they don't control yields, then they have basically a fiscal spiral. You have something like what, say, Europe experienced in 2012, until the ECB stepped in and basically said, we're going to hold this together. So you'd have basically rising yields in the U.S. and elsewhere, and you'd have budget deficits blow out, and then there'd be no clear way for them to recover that, right? Once debt as a percentage of GDP is that high and deficits are still widening, that's a disaster for the
Right.
solvency. And so I think at the end of the day, they're gonna let the currency go and control yields, because I think it's kind of the only way out. But of course, that's disastrous for cash and bondholders. But I think that there's a bumpy road between then and there, because that's basically a complete capitulation, right? That's kind of the end of central bank credibility.
Right.
To kind of to whatever. There's still some left in the sense that the market, they seem to fully believe kind of Fed tightening. They were, if you look at, say, oil futures, right? So priced out several years, 2025, 2026, they're much lower than current oil prices. The market still is kind of looking at this as rather transitory, that we're going to normalize this, that it's war related, even though it was all happening prior to the war. And so I think that the market still has that degree of credibility for the Fed. And it's not until that they have to stop tightening at some point. They run into one of those breaking points I mentioned, credit markets, treasury market liquidity, recession, something like that, with inflation still being a problem. And when they kind of fold, I think that yeah, that's when you kind of have that game changes. And I think probably currency devaluation is the most likely outcome.
Right. Okay. And of course, that's what we're seeing in Japan right now, which
Yeah.
is doing yield curve control, and we're seeing the yen depreciate substantially versus other currencies. It's interesting. So you talked about your barbell allocation earlier. Cash and long dated US Treasuries. You can make a really good argument to own them in that interim period while the Fed is tightening here. But you got to be cognizant that the game could change very quickly the way that you just talked about. And so we'll talk about allocation in a bit, but I'm assuming you would think that hard assets, including gold, but other tangible assets, are almost kind of like a call option on the end game that you're talking about there, right? That once yield curve control kicks in, those are the type of assets I assume you'd probably want to be in.
Yeah, I'd expect a big uptick in natural resources, both the stocks and then the actual resources themselves. So various types of commodities, oil, gold, copper, silver, Bitcoin as well. And then hard infrastructure, things like pipelines and assets like that. High quality real estate that's not particularly overvalued. There's different parts of the market where, you can get a nice quality asset with a low, if you get kind of a fixed rate mortgage on it, it's funny, mortgage rates went up a ton, but they're still below the official inflation rate.
Right.
And so I think depending on where you are, that's basically, it's a long-term dollar short, which I think would do well in that environment. And so, yeah, basically the outcome of them having to capitulate on tightening should be a big uptick in hard assets, specifically assets that are not facing a lot of margin pressure, which basically means commodities, commodity producers, hard monies, and things like that.
Okay, great. Like I said, I'll give you a chance to talk more deeply about that in a bit. But all right, so let's start banging through here. So remaining on inflation and the Fed for a minute, we had an interesting week where we had a meeting between Jerome Powell, President Biden, and Janet Yellen. I'm curious to hear, any speculation you have on sort of what was discussed there, and if there's going to be any shift in policy coming out of that. But one thing coming out of that I thought was really interesting was Janet Yellen was then interviewed, and she did a public mea culpa. She uttered the words, "I think I was wrong about." The probability of inflation given the policy steps that were being taken a year ago, which is a little bit unnerving, where you had somebody who actually ran the Federal Reserve, now runs the Treasury. That decision wasn't made all that long ago. What does that say about the quality of the intelligence that our central planners are using to make their decisions here, if they can be that wrong that quickly? Because
I,
folks like you, and I'll pat myself on the back a little bit too, but a lot of viewers too, with just sort of practical, thinking, said, hey, you pump several trillion, 10 trillion of combined monetary and fiscal stimulus into the system in a year and a half. There's probably going to be some inflation.
yeah, I think generally they're more backwards looking than forward looking, which is not good. And to her credit, it's good to admit that she was wrong, and it's also, it's hard to say ahead of time what the exact level of inflation is going to be, right? I mean, there's all sorts of variables that could have delayed it, that could have dampened it a little bit, basically, economies opening and things like that. But yes, a lot of us were looking at this inflation picture and saying that it's, we're not seeing the commodity capex. We're seeing a lot of new broad money in circulation, which was different than what we saw in 2008. Basically, just more money chasing fewer goods. And so, they called the whole inflation transitory thing. They were wrong on that. And I think it shows that we just don't really have the most data-driven people running things. And I think that, we zoom out really far. I think the biggest problem is that controlling the price of money is not a good thing to be doing, but it's just an inherent part of our current system design. But I think that's kind of an inevitable problem that you're going to have, just like, in most industries, price controls are not a good thing. And the problem is that there are a handful of things that if you control the price of them, it can distort everything else. And those would be things like energy and money, right? So those are kind of the master inputs that affect every other price. And so because by controlling the price of money or by controlling the price of energy, that can have a billion ripple effects down the road. And I think that's just the problem we face ourselves in the way that we've structured the system over the past century or so.
All right. So it's unfair for me to ask this question to you and ask you to give the brief answer I'm going to ask you to give. But I've asked this to a few recent experts on this program, and I think what I'd like to do is bring you and them on for a longer exploration of this. My question is, at the end of the day, do you think we should have a central bank that is trying to set the price of money, or should we move to a more market-centric solution? You're an engineer. I kind of liken what the Fed and the central planners are doing here is it's as if the pilot of the plane is basically trying to say, yes, I have an altimeter, yes, I have a fuel gauge, but I always want the height of the plane to be within this band and the fuel tank to be within this level of volume. And I'm not going to let the gauges go outside of that band, right? And so they're kind of fooling themselves of what true reality is. They're not using accurate instrumentation to fly the plane. So anyways, what are your thoughts on that?
So I think in the long arc of time, yes, I think that not having a central price setter for money is ideal, and that the price of money can be set in different regions by market forces. That's a system that used to be, and I think that in the future might have that again one day. I think a big challenge is that, starting in the second half of the 1800s, commerce started moving faster than money, right? So for thousands of years, commerce and money moved at roughly the same rate, which was, the speed of traveling around. But with the introduction of telecommunications channels, banks could settle ledgers across the world pretty quickly. And then of course, when you add the internet, it accelerates even more. Whereas the money, gold, still had, it still moves at the speed of physics, of matter. And so when commerce began moving much faster than the underlying bare asset, we had to abstract it in order to have it keep up, right? So we had to do claims based on that money rather than the money itself in order to keep up with the speed of commerce. And the problem there is that when you abstract it like that, when the speed of commerce greatly exceeds the speed of money, that allows for arbitrage and centralization. And so I think that that's been really the story of the past, call it 150 years of monetary history, is that policymakers have been able to arbitrage that difference and make use of the fact that we have a separation between the claims to the money and the underlying money itself. And so I think in some ways it was inevitable to happen. I mean, when we see something happen where, there's 200 countries, which country doesn't have a central bank? Which country has free banking currently? Which country is on a gold standard? It's kind of like once it became possible to do, it happens everywhere.
Right, right. And folks, the answer to Lyn's questions is, I believe, none.
Yeah, or at least, no major one that I can think of. Maybe around the margins, there's some little tiny one. But yeah, basically, when you have that large of a sample size and you see it does not happen, there's some degree of inevitability to it, which is unfortunate. And so I think that, after this particular system works itself out, we'll see what happens with the next system. Maybe we can go back to a different type of model that is more decentralized. But I think so. My answer is kind of that one, I don't think it's a good system, but two, just because of the order of technology we got, I think it ended up being somewhat inevitable, unfortunately.
Yeah. All right. Well, good answer. I'm sorry to ask you to address such a complicated topic in such a short soundbite here. One of the other elements, though, and I'm veering off this long list of questions, but this is really fascinating territory, is when you separate the commerce from the the currency from the commerce, and in the way that you're describing, it also opens up the door to derivatives, right? Where you have claims on the real things, but those claims start multiplying in all sorts of complicated ways, right? And then the danger is that you end up with way more claims than there actually are real things, right? So one that just provides systemic instability. And there's a lot of people that, look at the size of the derivative markets, which kind of, depending on how you count it, many ways you can count it, it just dwarfs everything else, right? And there's a lot of uncertainty there, meaning if one domino falls, we have no idea all the other dominoes that might trigger, right? Which is why, the great financial crisis, caught so many people by surprise. So you have all those issues, but kind of at a higher level, I want to go back to the debt just for a second, because we have allowed for all this borrowing to go on, and we have a highly leveraged system as well. I mean, the economy runs on credit, and so when you have hiccups in credit, you have hiccups in the economy and its stability. We've already talked about a few times in this discussion that there's so much debt out there that the Fed is really trapped by it now. And I guess my question is I kind of feel like we are held hostage to some of the shortcomings of the system that have allowed all this debt to build up. A lot of it is unproductive debt. And now our options are increasingly constrained, because the answer is, well, we can't do that, because if we do, the whole debt pile, just becomes an inferno and burns everything down. Is there a potential way in which we can have these, the malinvestment, the bad debts clear the system, and get back to a more sort of sane and sustainable baseline? And even if there isn't an elegant way to do that, would we be better off if it did? If we just took the pain, had a massive depression for some focused period of time, and yeah, it would be god awful, but we could emerge from it kind of free of the shackles of this increasingly, hostage situation that we find ourselves in?
I think the challenge is that because we've constructed the system this way, it becomes like a shark that can't stop swimming, otherwise it drowns. Basically, the debt, a credit-based system has to keep growing, otherwise it collapses. There's kind of no in between. So, so let's say you go back theoretically to the 1800s. You have, gold as base money. You have claims on that. Claims maybe a few multiples of the base money, but it's not massive, right? And so when you have a recession, some of the malinvestment gets cleared out, and you kind of restart from there. Whereas going back to like 2008, there were something like 60 claims on base money, meaning that, for example, the total debt in the system, just from memory, was something like 60 times higher than the amount of base money in the system.
That's just bananas, and I'm sure it's worse
Yeah.
now. But anyways, continue.
Well, it's actually less now because they
Oh,
created
that's
so much
good.
new base money, but it's still, I mean, it's
You're right.
double digit multiple. And so, and we saw the same thing kind of happen back in the 1920s, where you had, this huge gap between all the debt in the system and then the base money, and then ended up increasing the base money. And so I think the way the system's structured, it's hard to do it in a disciplined manner. It's again, it's kind of like asking, why are there no countries with no central banks? And it's kind of like saying this system is kind of it's designed to always grow. And I think that until we kind of structure the system differently, it's hard to do it in a sustainable way.
Yeah,
Now,
I'm sorry to interrupt, but I want your remaining answer to address this point, which is because you brought up the limiting effect of finite resources out there, right? So we have a system that's designed for eternal growth. We are entering a period where resource growth is becoming constrained. So at some point, isn't the system almost sort of doomed, that it's never going to get the eternally growing resources it needs to always grow the way that it mathematically has to?
in the long arc of time, yes, I think so. And that sounds, doomy, right? But I think if you go back in history, I mean, these sort of systems don't last this long. This particular fiat system from the 70s has been the longest lasting and most sophisticated, grandest version of it. But I think people should be careful about having recency bias. They think that the systems function this way for 50 years. Why can't it go for another 50 years or 150 years? But the history of the world is kind of the history of changing financial systems, changing money, kind of changing things like that. And so I think that as we look out longer term, I do think that this system's unsustainable, and that the way our money works, decades from now will probably look quite different than how it looks now.
All right. And my guess is, don't let me put words in your mouth, but one of the reasons why your hair's not on fire and you're not running around saying, oh my gosh, the fiat dollar system is going to collapse eventually, is you have some optimism that blockchain-based solutions may provide, sort of an interesting successor to what's going on here.
I think that's the most credible way to maybe introduce something new, right? But it's still early technology. I mean, Bitcoin's 13 years old. It's being tested to see how it's going to handle that. I think basically digital bearer assets, particularly if one can capture the majority of the liquidity and network effect, introduce a new way of doing things. But that's kind of the the expectation or the hope of the expectation of what's possible. But there are still ways that that can be messed up or that that can be disrupted in some way. So it's something I'm watching, and I think it's worth looking at it, building on it, exploring it.
Okay, great. Interesting potential, but open to other solutions emerging
Yeah.
as well. All right. God, I've got so many questions to bang through here. We'll just do our best. Again, I want to note one other element that caught my attention last week was there was a video clip of Lagarde being interviewed where the gentleman who was interviewing her was basically looking at the ECB balance sheet and saying, does this keep you up at night? How fast this thing has grown? And she said, well, it will be brought down in due course. And he kind of kept pressing her, and she just sort of kept saying, in due course, it will come, right? And to skeptical folks like us, that looks potentially very evasive. Is that sort of review? I guess my question is do you think the central banks are really ever going to be able to normalize their balance sheets, or are they just telling us so as not to freak us out? But we're in an era where those balance sheets are only going to grow over the long haul.
Yeah, I think they're unable to normalize them. They could stop growing for periods of time. They could even shrink for short periods of time. But I think until we have a structural change, I think we're in an environment where they're kind of forced monetizing. And ECB is in a particularly rough spot because their countries, their sovereign bond markets can't really work without ECB support. And so, for example, if you look at Italy, ECB bought basically all Italian bond issuance over the past number of years.
Sorry, I'm chuckling here, but we talk about zombie companies, but it's like you've got zombie sovereign credit markets over there, is what you're saying.
Yeah, and it's some people will compare that to the United States, and the United States has a host of its own problems, particularly negative net international investment position and trade deficit that is worse than Europe. But one area where we don't have is that our states are not as insolvent as European countries. And so, for example, if we look at the top 5 U.S. states, their debt to GDP on the state level is actually relatively low because we have a fiscal union and a monetary union, right? So we all share the same money, and then our states share most of the same, kind of entitlement military system. So that's abstracted away from the state level for the most part. And so, their debt to GDP might be say 10%. Whereas if you look at Europe, you have a monetary union without a fiscal union. And so the countries are responsible for their own systems. And so they enter that union with high debt levels. It's only got worse from there. And so Italy, for example, has like 150% debt to GDP, and that's just completely unsupportable without the ECB support for those bonds. Basically, there's not a lot of foreign demand for those bonds, especially at those rates. And if the rates ever went high enough that actually would attract foreign capital, it'd be a fiscal spiral. There'd be clearly no way to pay, no way to support the interest on that debt. And so the Fed's trapped, ECB's trapped, Bank of Japan's trapped, where especially the ECB, but basically they're kind of stuck in this position where they have to support their sovereign bond markets, and that can come at the expense of currency devaluation. And so I don't think they're going to be able to normalize anytime soon, although some of them, like the Fed, can do these periods of pushback, which I think is why people have to be careful with how aggressive they get, what their timing is, if they take on any leverage, because central banks can temporarily fight back pretty hard.
Okay. All right. God, I'm so resisting asking your thoughts about the long-term viability of the euro, but I'm going to have to leave that dangling out there because that's another long discussion. All right, so let's get into what the central banks are trying to do right now. What the Fed is hell bent on in the short term, which is demand destruction. Right? Jay Powell has been talking very frequently and very vociferously about this. He has invoked the name of Paul Volcker many times. And he basically has said, look, I can't do much about the supply side, but I'm going to do everything I can about demand. Jobs market, I'm coming after you. to a certain extent, not that he's really said it, but housing market, I'm coming after you. And clearly, we've already seen the financial markets, get whacked pretty substantially at the beginning of this year, both stocks and bonds. So let me just bang through a couple of topics here. And you alluded to this earlier. I find it hard not to have interpreted Powell's press conference from last month as basically saying, I'm declaring war on jobs. He put up the chart several times of the 2 job openings for every applicant, said, I just think this is, it's too strong right now. I got to bring that down. We're already beginning to see, some cooling off in the job market. There's some charts I think you put up there showing the difference between the absolute number of jobs versus the year percent changes in job openings. Initial claims are starting to rise. Granted, they got down pretty low, but it looks like we're seeing a secular reversal there. And then I've got a chart I'll put up here of tech startups. Tech startup layoffs. I've been sort of showing this chart on Twitter as May has been progressing. And you can see starting about 2 months ago, layoffs are really shooting back up, kind of the levels where we were at in kind of mid-2020, right? So it's not apocalypse yet in the jobs market, but we're certainly seeing some real signs that employers are starting to pull back. And of course, they have a progression, right? They go from hiring freezes to then shortening hours and then to layoffs. But like I said, we're already beginning to see layoffs, begin to creep into the picture here. So how worried are you about what's the job market from here?
I think that's one of the key things to focus on. I think we're going to see more weakness in the job market. Basically, the Federal Reserve has 2 mandates and a shadow mandate, right? So they want to have stable prices. They want to have low unemployment. And they want to, the shadow mandate is financial stability, right? So if something goes illiquid, especially if it's like a treasury market or credit market or something like that, they have to address that. And so with official inflation as high as it is, and with official unemployment as low as it is, and with nothing, really seized up in the financial markets yet, their clear mandate is to try to tighten and to decrease inflation, increase unemployment a little bit. And so that's the path that they're on. It's like an algorithm, and they're following that algorithm. And I think the challenge is that the walls are closing; they're getting narrower and narrower. So that they basically balance between trying to support those 2 mandates, and it gets closer and closer, where you eventually just get stuck, where you're kind of already you're fully focusing on one, but you still can't fix it, and the other one's closing in on you as well. And so I think that going forward, until we see their shadow mandate come into play, until something in financial markets truly breaks, like treasury market liquidity or credit market liquidity, something like that, I think their clear focus is going to be on softening the job market. And so I would keep looking at that as a key thing to watch going forward. And I think that over the next 6 months, 12 months, we're going to see that shift towards a weaker job market. And it might or might not bring inflation down. Depends on what happens with oil production, what happens with China reopening, right? There's a lot of variables that can affect specifically what happens with inflation. But I think longer term, the inflationary forces are going to remain, and that they're going to have to end up backing off their decision to create more unemployment.
Okay, and so I'm gonna bang through a couple other topics here real quickly that I'd love to spend more time on individually, but we're just time constrained here. But where I'm going with this list is to the question of by decreasing demand so much and creating a negative wealth effect, which is really what the Fed's trying to do to bring demand down. How big is the risk of tipping into a recession here? Because part of what I'm trying to do for the folks that watch these videos is to kind of let them know where the puck is heading, so that if we think, hey, we could be entering a recession where stock prices might continue going down further, your house price might come down, your job might be at risk. I want people to know the relative probability of that, so that they can take prudent action now in their lives if they feel unduly vulnerable to any or all of those factors, right? So real quick, I'm putting up some charts that I've seen you share recently. The May for manufacturing, we're seeing that the May ISM data is rolling over. If we look at the forward-looking data, it's doing the same. So, manufacturing's weakening. The housing market, you mentioned that mortgage rates have risen dramatically in a relatively short period of time. Roughly, they've doubled pretty much since last summer. Obviously, just mathematically, that's going to have to start bringing prices down, in addition to other factors that may be cooling the housing market off as well, at least in certain regions. Energy costs, just cost of living, is persistently high for folks, and may in certain key areas even go up further. Who knows? But at least the pinch everyone is feeling, it doesn't look like it's going to go away anytime soon. And then if we look at households, even those that remain employed, we're seeing real wages continue to decrease month after month after month. I think we're something like 13 months straight of decreasing real wages. And with all of the extraordinary stimulus that was pumped out there in 2020 and 2021, that is done. And we're basically seeing that, people are maintaining their current lifestyles, but they're doing so by putting it all in a credit card. So we're back to, record revolving credit balances and whatnot. So that seems to be, a pretty predictive indicator that household finances are getting, more and more precarious. So I just rattled off a whole bunch of these things that basically suggest, hey, we could be in a pretty painful sort of recessionary position, I don't know, at some point in the next 6 months to 2 years or whatever. How worried are you about this, about America entering, a tougher time?
I think there's a significant probability of having a recession. And one thing to keep in mind is that recessions are measured in real terms. And so, for example, if inflation's 8% and nominal growth is 5%, that's a recession, right? So you're basically negative real growth for a prolonged period of time. And so we already saw negative.
And I'm sorry to interrupt, but we also have negative nominal GDP growth in Q1 and Q2 TBD, but the numbers coming down if you look at the GDP now numbers from the Atlanta Fed. So we could be in a position not too long from now where we're having back-to-back nominal negative growth periods.
Well, Atlanta Fed is real indicators, so they're looking at the real GDP.
I'm sorry, you're right. It is a real GDP number.
Yeah, but basically the hurdle rate is super high when inflation's high. And so that's kind of the challenge you run into. Basically, it ends up looking like an emerging market recession where, GDP in local currency terms is still going up, and maybe stock prices and even housing prices in local currency terms are still going up. Like if you look at Turkish equities or Turkish real estate prices in lira terms, they're going up. But in dollar terms, they're of course struggling. And so I think that, in a more mild sense, that's the kind of the environment we're in now, where real growth is struggling. Could be negative, could be very low positive. If we end up having a negative real GDP print this quarter, then we're arguably already in a mild recession at this point. But it's hard to say if that's going to happen. It kind of comes down to how accurate you believe the ones compiling the data are, right? Because these are inherently hard to measure. But I think that it's clear we're in a slowdown in real terms. And depending on some variables, like what happens with energy pricing, what happens with policymaker decisions, I think that easily could morph into a recession over time. I think that's a significant risk going forward, especially when you look at it as we do in real terms.
So, what's interesting to me is, we've conditioned the public that at the first sign of pain, the authorities are going to step in and help out. And you can say they needed to or whatnot, but we had the kind of blink and you miss it recession in 2020. So whether or not you got laid off or whether or not your stock portfolio got whacked in March or April of 2020, your stock portfolio did great by the end of the year, and even if you didn't get hired back, you got pretty substantial government support. So I guess my question is, I don't see a lot of fear in the average consumer's eyes about recession right now. In fact, we still are sort of seeing the opposite with this great resignation, where people are still being very choosy about whether they want to go back to work or what type of job they want to take. My concern is that, I could make an argument that in a year's time, we're going to go from a jobs glut to a jobs drought. And all of a sudden, people are going to be, it's going to be the great unretirement movement, right? People are going to be begging for their old jobs back. Those jobs might not even exist if the companies have laid off. So I guess my question is how how, for people that are entertaining the idea of a recession could arrive, from your just best guess, is it going to be a light one and don't worry too much about it, or is it one that people actually should be taking precautionary action now for? I mean, could it be relatively prolonged? Could it be relatively deep?
I think people should take it seriously.
Our interview with Lyn Alden will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Last, if the challenging macro outlook that Lyn has detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Lyn has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Lyn Alden.